In this week's video, we'll review the latest charts to help us answer the question, is the stock market flashing bottoming process signals? If you follow along on Twitter, you might remember after the close on Thursday, January 3rd, despite the 62-point drop in the S&P 500 that occurred that day, we noted there were some interesting things going on behind the scenes that told us to keep an open mind about better than expected outcomes. Of course, Friday's session was quite a bit better than Thursday's. During the course of the video, we'll be covering charts and data points relative to this topic. The two charts that follow come from Tony Dwyer's How to Identify a Bottom from a Probability Perspective toolkit. It's typically a good sign historically in terms of trying to put in a low when we see the S&P 500's 10-week rate of change move from below -9 back to -5, which is exactly what we've seen happen. During Friday's session, it was back above -5 at -4.8. Obviously, if the market is going to change direction at some point, we have to flip over from bearish conviction dominating bullish conviction to seeing a thrust where bullish conviction allows for a turn in momentum. Very, very similar situation here. When the VIX is rising, it's telling us expectations are for further volatility going forward. When the VIX starts to calm down, it speaks to lower fear and lower concerns about future volatility. From a bottoming process perspective, typically it is a good sign when the VIX's 10-week rate of change drops from above 80, as it was earlier in 2018, to below 10. As of Friday, January 4th, we're well below 10. In fact, we crossed the center line. These charts tell us to keep an open mind about a bottoming process. Later in the video, we'll talk about some of the keep an open mind things that we saw after Thursday's session. One of the negative things about Friday's session was at the close at 4:05 p.m., so we're comparing apples to apples, volume was not particularly impressive, telling us that even if we are trying to form a bottom, the S&P 500 still may have some consolidation and whipsaw work to do. Most of these charts we covered in last week's video, so we'll move quickly. Friday, January 4th, NYSE still looks like it's trying to hold the 61.8% retracement relative to the February 2016 low point A and the high that was made earlier in 2018 point B. If that's the case, from a longer-term perspective, it's possible that this is a normal retracement within the context of an ongoing uptrend. If that's the case, and that's to be determined, if the uptrend is still intact and this is a normal retracement, we have to be open to the possibility of higher highs in the months ahead. Similar situation, S&P 500 index Friday, January 4th. Same A to B move. Lows in 2016 to the high in 2018. Thus far, it looks like a 50% retracement of that move. The longer price remains above the 50% retracement, the more meaningful it becomes. Last week, we said this chart was trying to hold at what was potentially a logical level. Now we have a bounce at that level, telling us to keep an open mind about better than expected outcomes. In terms of still taking a skeptical and measured approach, we know that what once acted as support may now act as resistance, telling us that the S&P 500 may run into some trouble Here, we'll just take it day by day. It's another chart that tells us to be open to better than expected outcomes in the weeks and months ahead in the stock market relative to the bond market. Based on recent price action in the past 20 years or so in this ratio, this area here would be a logical area potentially for the ratio to bounce. To be determined. Similar situation here, just looking at it from the other perspective. GOVT in the ETF world is similar to an IEF or a TLT. It's a Treasury bond ETF. We're looking at GOVT relative to the S&P 500 or SPY in the ETF world. Interesting to note, resistance for the ratio, resistance for the ratio, resistance for the ratio. This looked like a bullish breakout. Now it looks potentially like a failed bullish breakout. The bullish breakout favored bonds. The failure, as of January 4th, now appears to be favoring stocks. To be determined. But the interesting thing is, last time the ratio was rejected at the same trend line was February 8th, 2016. If you know your market history, you know the S&P 500 made a major low 3 calendar days later, telling us, despite the horrible drawdown that we've experienced over the past 90 days or so, 2016, there was a horrible and gut-wrenching, we feel terrible, drawdown for investors in the stock market. For those who stayed focused here and continued to execute properly, what happened next from point A? Really good things happened from point A. The S&P 500 did indeed make a low, and it rallied 57% from this low to the high in 2018, telling us, even in a hypothetical situation where $1 million portfolio takes a 20% drawdown, if it gains 57% after the drawdown, the account would move on to new highs over 1.25 million, emphasizing the importance of remaining focused. Stock market history tells us we can go from feeling very, very bad to feeling better in a relatively short period of time, assuming proper focus and execution. Given the items that we just covered and some of the items that we'll cover in the remainder of the video, it is possible in the present day we have a favorable risk-reward entry point similar to this point here, hence the reason for the small scale in during Friday's session. If the market can continue to prove things to us, we're happy to continue with the scale-ins. If it doesn't, that's the reason for the incremental, measured, and somewhat skeptical approach. Global Dow, January 4th, 2019. Bad news, glass half empty. The Global Dow has given back a good amount of gains. In fact, the ratio is trading basically at the same levels that it was trading way back in 2007. The good news is what once acted as resistance, may now act as support. We've covered this in the past. Market breadth as of the close on January 4th, 2019. This is the look that we want to see relative to a bottoming process. Doesn't mean a low is in, but it's a good sign in terms of possibly seeing either a low or consolidation and or a successful retest of the recent low. This is one of the charts that we'll cover later in the video relative to good signs on Thursday. Bank loan ETF had a wonderful follow-through during Friday's session as well. The charts that follow pretty much speak for themselves, so we will be moving quickly. S&P 500 in the center, daily chart, January 3rd, 2019. In all three cases, we have the 200-day moving average in red. We're comparing apples to apples. This is 6 trading days after the Christmas Eve low, 6 trading days after the low following Black Monday, and 6 trading days following the first low after the plunge in 2011. Quick takeaways. 1987 trend before the plunge, the strongest. A lot of white space in here. 2011, can make the case that it is stronger than the present day. Why? Here, we've only touched the 200-day 2 times. In 2019, multiple touches, and then we tried to recapture it 3 times and failed. Interesting take here about keeping an open mind about all outcomes. Now we're looking same exact period, 6 trading days after the low. This is the 200-week moving average. You can see in 1987, the low was made by kissing the 200-week in red, almost identical to what we have in the present day. So far, the low that we've made kissed the 200-week here in red. Similar situation in 2011, but it's a downward sloping 200-week. Probably fair to say charts A and B look more alike relative to chart C. But in all 3 cases, the bottom was made near the 200-week moving average. Now we're looking at the simple 11-month and 13-month moving averages. Same thing, 6 days after the initial trading low. We're using these moving averages for illustrative purposes only. Probably fair to say this looks the worst, this looks the best, and this is in the middle. Huge caveat on the 2019 chart. If we look at this chart as of month end, 12/31/2018, we do not have the bearish moving average crossover. This chart is as of January 3rd, or during Thursday's big down day. It's quite possible this chart will repair itself before month end, but all 3 of these charts are intra-month, so right now we're comparing apples to apples. We want to make sure we're not being biased here. 1987 is a bullish resolution. 2011, good things happened. Therefore, let's make sure we're giving the bearish case equal time. Let's replace 2011 with 2008. Probably fair to say 2008 looks more like the rollover and weaker look in 2019. Similar, strongest. Interesting to note again, all 3 cases, the market's trying to make a stand at the 200-week moving average. 200-week moving average, 200-week moving average. And once again, with the caveats that we don't know what this chart will look like at month end, as of January 3rd, probably fair to say this is the weakest of the 3. So as we walk through here, we can probably learn the most from this case, and it is probably fair to say this setup here, in terms of touching the 200-day, rolling over, trying to recapture it a couple times and failing. So what can we learn if we make this chart bigger and move in this direction? 6 days after the initial low, similar to this point on January 3rd, was January 29th, 2008. So we're looking at the exact same chart, just a bigger version. If we fast forward, the market rallied 2.43%. And then from that high, notice the box up here. It retested the bottom of the box, basically. What once acted as support may now act as resistance. From point A to point B, this is a retest of this low. The market dropped 9.92%, which aligns well with the after a plunge, markets often consolidate and whipsaw for a time. What happened next? We originally recorded this on Thursday night. Due to computer problems, we're re-recording it on Saturday morning. But it was interesting to note, on Thursday night, we said In the present day, what we're looking for is a second strong conviction candle, and that would increase the probability of a successful retest. We don't know if we have that yet from a retest perspective, but we definitely have matching or back-to-back strong conviction candles now in early 2019. This second strong conviction candle, and I realize we're looking at high-low closed bars, but it's easy to discern based on this high-low closed bar what these candles look like. What happened next after what appears to be a successful retest of the initial low? Despite all of the negative bearish sentiment down here, and I lived this real time, so I can tell you, not many people here or here expected the S&P 500 to rally all the way back to the 200-day, which was a 13.43% rally from the lows made in March of 2008. And remember, this candle here is somewhat similar to early 2019, but now we can also make the case that this candle here could be similar to Friday's session, telling us to keep an open mind about the possibility of a reversal. We also have to keep an open mind about the possibility of a bottoming process. In this case, it took 48 calendar days between the initial low and the strong conviction reversal. We're not reviewing any of this to predict anything. We're trying to understand a wide range of possible outcomes so we can remain flexible and open-minded. One of the key takeaways here is the things that we're looking for at an intermediate term low, which turns out to be a counter trend move in this case. What we're looking for at a low is very, very similar for a counter trend rally and a sustainable low. So this reversal has similar characteristics to the reversal in 1987, 2011, and 1998. In all three of those cases, the market went on to make new highs. In this case, the market did not go on to make new highs. What happened when the market went up and tested the downward sloping 200-day moving average, which is this point right here? The answer is really, really bad things. The moral of the story for us here is we don't want to front run the data. Why? Because in this case, and we went back and checked, the model does start to scale back in an incremental fashion, but it doesn't even get close to being fully invested at this point here. Why? Because the data says there's still weakness and that the market could be vulnerable to a reversal. So when you get to this point here, the hard data says you should own some stocks, some bonds, some cash, and remain open-minded. If you move in this direction, you can always add to your stock holdings. But when you move back in at a measured pace, it puts you in a much, much better position to migrate in the proper direction when we get this spectacular failure here. With the benefit of hindsight, this is one of the best add to your defensive positions, add to your shorts entry points in the history of mankind. A market with a weak profile rallies back to a downward sloping 200-day moving average and fails spectacularly. The additional loss from this point here to the low was 52.55%, emphasizing even if we get signs of a strong conviction reversal and a rally in 2019, we have no idea how far that rally will go and whether or not it will fail when it reaches the 200-day moving average or any other point. Therefore, for us, nothing new. We need to be patient and take a prudent, measured, and data-dependent approach here. If we get a case like this, the data can handle it, as long as we're properly allocated along the way. If a reversal, and we don't even know if we have a reversal, this is all hypothetical. If we get a reversal in 2019 and it turns out to be more like 1998, 2011, or 2016, where the market went on to make new highs, that's fine. You just continue to scale in once the market proves it to us and the data improves further. Maximum flexibility. We don't want to feel like we're missing out on something every day. If you think about it, from this point here to this point here, really absolutely nothing happened for 1, 2, 3, 4, 5 months before the downtrend resumed in a very, very harsh manner. Day by day, measured, get all wound up about movements on a daily basis. There's a lot of whipsaws and head fakes in here. Some days, cash looks good. Some days, stocks look good. Some days, bonds look good. And even if we get a bullish resolution in the present day, we still could go sideways for several weeks or months and then retest the low that was made in late 2018. All to be determined. It's also quite possible in the present day that the market blows through the low that was made on Christmas Eve. Let's go back to some of the charts. What prompted this tweet after the close on Thursday, January 3rd? S&P 500 got hammered, down 2.42%. Number one, senior loan ETF was green on Thursday. Good sign. Regional banks during the session on Thursday at one point were green. They finished red, but significantly outperformed the S&P 500. Potentially a good sign. Trading volume, relative to what we had seen in the rearview mirror, appeared to be a little bit tamer. This is the number as of 4:05. It was an above average day when everything settled in at 143. But that's relatively low when we compare it to these down days, 214, 252, 255. At the close on Thursday, January 3rd, when the market got hammered, the VIX had somewhat of a doji look and was well below the recent highs, looking like the VIX is trying to calm down a little bit. All to be determined going forward. These are anecdotal pieces of evidence telling us the market could be in the process of trying to form or make a bottom. Remember, we said the bottoming process for a counter trend rally looks very, very similar to a sustainable low. So let's assume here in the present day, if we get something like this, we just take the attitude that we're in a downtrend, we're going to ignore it. Well, if it turns out to be more like one of the bullish reversals, then we could regret that going forward. The bottoming process is similar, but in this case, the outcome was very, very different from the bottoming process and reversal in 2008. From the lows in 1987, good things happened for a very long period of time, telling us that something like a 20% plus drawdown isn't earth-shattering from a longer-term perspective if we execute well. In life, in trading, and in the money management business, it's very, very important when things don't go well to take a step back, rip it apart, review it, and ask the question, what can we do in the future to improve? As we covered last week, added the new screens, finished 2017 on a strong note. In September of this year, model was doing just fine. And then from this point here, really, in our mind, unacceptable results. So if they're unacceptable, and we know in markets that if it happened before, it can happen again, It's extremely important to review, see what went well, what didn't go well, and what changes we can make, and we have already made some changes. We're going to cover those now. November 2nd video. We outlined the case that the October 29th reversal in the S&P 500 could potentially be the early stages of a bottoming process. This could be, from a probability perspective, a sustainable low. This is October 29th. Talked about it on November 2nd. Were long-term treasury bonds telling us that treating this as a possible sustainable low was irrational? Not based on the facts that we had in hand on October 29th. This is VUSTX, mutual fund world, basically identical to TLT or long-term treasury bonds. We're using this because it has a longer-term track record. You can make an argument when the S&P 500 printed this reversal type looking candle here with a very, very long tail, that the monthly chart of, let's say, TLT looked as bad as it's ever looked going back to 1990. How can we say that? This is the 50-month moving average. Long-term treasury bonds down 2% month to date on October 29th, making new lows, and for the first time on this entire chart, falling below the 50-month moving average. Same charts, we're just zooming in. This is what went well. We're going to get to what didn't go well. October 29th. This doesn't look like a bond market that's telling you to run for the exits here. November 2nd. The long-term treasury chart looks worse. The closing price here on October 29th, 1107, lower on November 2nd at 1087. So when we outline this whipsaw try to be patient plan on Friday, November 2nd, long-term bonds seem to agree with the thought of being patient. This chart is making a multiple year new low. This appears to be a bearish breakdown. It's as low as it's been since 2015. And it's below the 50-month moving average for the first time in a very, very long time, on the order of magnitude of the last 28 years or so. One possible explanation for getting potentially bad signals from the bond market is the Fed's quantitative tightening program that we covered a few weeks ago. Remember, quantitative easing is a little bit different than open market operations. One of the ways that it's different, QE consists of large-scale asset purchases by central banks, usually of long maturity government debt, which is different from the type of maturities that they typically use in open market operations. Therefore, it's possible with quantitative tightening, when the Fed is letting its balance sheet run off and letting the bonds mature, that the Treasury Department, issuing new bonds to roll over that debt, is flooding the market with new supply and hence potentially artificially depressing Treasury bond prices. That is one possible explanation. However, it's very, very dangerous in the markets to start explaining away what you see on a chart. If we do that here, what prevents us from doing that in every single case? This is what we had in front of us on October 29th and November 2nd. It seemed to be very, very logical relative to the plan we laid out. From a longer-term perspective, October 29th below, November 2nd, when we outline the whipsaw reduction plan in the video, it looks even worse. Already down 1% for the month, 2 calendar days into November, and below the 50-month. This chart is as of January 2nd. Notice how confused we are in here. We get the bearish breakdown, and then what appears to be a false breakdown, a reversal, and then a bullish breakout. The look of this chart here is radically different from the look of this chart here. It's possible that this is a nimble barge reversal here in favor of bonds. But based on what happened on Friday, it's probably more likely to say that we're still near some type of indecisive inflection point. We'll continue to take it day by day. This is a very, very difficult look on this chart. This looks like a confident look for the economy and stock market, and then it looks to reverse to a dire look for the economy and stock market. Day by day going forward. No extrapolation, no extrapolation. Our purpose here is we're ripping apart what happened to try to figure out what went wrong and how we can lower the probability of that happening again. Don't really see any problems with the read here. The basic assumption on the whipsaw situation here was that it wouldn't be surprising from this point forward to see the market go sideways and consolidate with a lot of head fakes. Well, if we fast forward 42 days, what we anticipated is basically exactly what happened. Don't really see any major problem with the concept of a whipsaw rule. How it was implemented within the bigger picture could be a problem, and we'll get to that. But the basic expectations here, fine, no major problems with that. And you can see as of December 14th, this is before the Fed. For the most part, we've remained inside of this area here. And remember the concept. It doesn't really make sense to set your stop inside of a trading range. Thus, our objective here is we never, ever, ever want to have gains from this point to this point and this point to this point and then see a drawdown like this, giving back months and months or years of hard work. We understand that we're not in the probability business, we're in the returns business. So despite the fact that we knew a 20% drawdown from here was an extremely low probability event from a historical perspective, we also knew that the probability was not zero. It's never zero. Thus, as we mentioned last week, our objective here is how can we improve in 2019 and going forward? Given the first whipsaw cut was made when we broke below the box here on December 17th, and given the S&P 500 was here at much, much higher levels in late January of 2018 and at even higher levels with higher profits on the books in late September and early October, cutting here is obviously far from optimal. And given the fact that just looking 12 months in the rearview mirror, we have a decline here that really doesn't match the mathematical profile here from a probability perspective, and we have a decline here and a drawdown that doesn't match the big picture from a probability perspective, we're putting new procedures in place and have already put the basics in place to be able to do two things differently in the future. While the big picture profile wouldn't have anticipated something like this, there are things that we can see here in the technicals, in volume, in the slope of this line that can raise some red flags telling us that it may be prudent to protect some profits here and to sell into strength. We have a list of specific red flags to look for. All we have to do going forward is we're going to do some more research, try to tighten up that list or tweak it a little bit. Given what's transpired in the past 90 days or so, it's also extremely important for us to be able to deal with something like this. So we also have procedures in place, very specific procedures. We call them circuit breakers. So what we're doing here is very, very similar to what the exchanges do. The exchanges have circuit breakers to try to prevent stock market crashes during unexpected plunges. We can do the same thing here by making decisions relative to either our cost basis and or our profit level here. And instead of cutting here, we can start cutting much, much earlier in an incremental fashion to ensure that nothing like this happens again in terms of the order or the magnitude of the disappointment and the drawdown. We'll continue to work behind the scenes performing research to tighten these things up and test them, and tighten these things up and test them. But these procedures were in place when the market opened for the first trading day of the year, and we will continue during the year to look for ways to get better. Had we done something like this, the impact of what the Fed did or didn't do down here would have been muted in a big way. But it's still important to review our expectations for the Fed. As we mentioned in a previous video, the market, for the most part, when you look at where price was heading into the Fed, was also somewhat taking a wait-and-see approach because all of these lows had not been taken out yet. So I don't really see any problem with the way we read the Fed and expectations for the Fed based on history. And just as a reference point, other firms, including Tony's, that use data had a similar take relative to the odds up here. We are data-driven. There was nothing in the metrics we used to suggest a 20% drop. We know this was a low probability outcome, but low probability outcomes happen from time to time. That's why we call them unexpected events. Hence, it's extremely important that we account for that going forward, and we've made the proper changes. So I believe our assessment of the odds up here was fine. I believe our read of asset class behavior was prudent, especially even looking in the rearview mirror. And it's not our opinion that the Fed typically would have either thrown the market a guidance bone or deferred the rate cut. That's a factual statement. You can look it up. Extremely rare for the Fed to do what it did here. And I think based on what happened on Friday, at least the early returns are that our expectations and read on what could have happened here. If the Fed had delivered here, it's within the realm of possibility that we would have cut only by about 17 or 20%. The market could have rallied sharply in this direction, as it has many times in the past when the Fed threw the market a bone, and we could have kept 80% of our positions. We thought, based on everything we knew in history, that the Fed would throw the market some type of bone. It might have been raising rates, but giving much more flexible and dovish guidance. What we expected to get here was what the Fed finally delivered on Friday, January 4th. This is what we were expecting here. Did the market react to this in a bullish manner as we had anticipated here? The answer is absolutely positively yes. Intraday chart, Friday, January 4th. Fed chairman starts throwing the bones right here. The market goes almost straight up, which is what we were expecting could potentially happen here. From this point here to this high, the market tacked on 50 points. Therefore, is the Fed to blame for our problems from here to here and down to here? The answer is absolutely positively no. We are responsible for our results. Uncertainty in the markets, including uncertainty relative to Fed statements, guidance, and market reaction, are all part of the equation. The answer is we have to do a better job accounting for that uncertainty going forward. And the process of ripping this apart is not to make excuses. It's to assess, understand what went well, what didn't go well, and find concrete ways to improve to significantly lower the probability of something similar happening again. I don't think that our additional research on these topics will change much from a policy and procedure perspective. If it does, we'll cover it in future videos. Now let's assume going forward that we have the circuit breakers in place, which we do, and we have rules to potentially sell into strength when we see things like this. On another topic, was it unreasonable to treat this potentially as a decline within the context of an existing uptrend? Well, sometimes it's good just to get another perspective. This is a daily DeMark chart of the S&P 500 index as of the close on Friday, January 4th, 2019. DeMark charts and indicators are proprietary tools from Market Studies, LLC. If you know DeMark, you know TDST is somewhat of a demarcation line for trends. This is a TDST low on the daily DeMark chart of the S&P 500. When this line turns solid, it's DeMark's way of signaling this is a qualified bearish break of this line in the sand. From a probability perspective, as of the close on December 18th, TDST officially said, okay, the trend has now flipped from up from a probability perspective to down. Given our first whipsaw cut came before that on December 17th, in terms of assessing what went wrong, I don't think we have a big problem with trying to be patient relative to an uptrend versus a downtrend. Human beings do not like uncertainty. That's why investors love forecasts. It makes them feel comfortable. So what humans like to do, they like to extrapolate. So when you're down here or here, everybody knows what's going to happen. We're going to continue to plunge in this direction. Nobody really expects a strong conviction reversal, a rally, anything like 13.43% all the way back to a downward sloping 200-day. And once we get here, everybody wants certainty. Everybody knows the low is in. We have a new bullish trend. We're going in this direction. So many get caught off guard when the stock market plunges over 52% from this point here to this point here. Thus, in the present day, it doesn't feel good right now, but it is way too early to determine what the longer-term outlook for us looks like at this point. What we just reviewed there basically says the only way to navigate from here, maximum flexibility, keep an open mind about all outcomes, and stay aligned with the data. Given that we've identified the issues and put some solutions in place, was there anything about this experience that's positive that we can carry going forward? The answer is yes. One of the most important things in the market is discipline and being able to execute properly. We laid out the plan on November 2nd and executed over a very, very difficult period. And we executed very, very well. Why is that so important? Because if you arbitrarily make things up on the fly in the markets, typically things don't end well. So let's assume that we panicked and moved the line in the sand up to this level here. Is it possible that that would have produced better results in the short run? Absolutely, it's possible. But in the long run, it sets a dangerous discipline and execution precedent. Why? Because if we're willing to move this line up, then nothing says in a situation like this, or this, that we won't arbitrarily and on the fly decide to move our lines in the sand down. Breaking our discipline in the long run can have devastating consequences. The fact that we remained extremely disciplined and executed well under very adverse conditions, especially given we have the fixes in place, bodes very, very well for our future under bullish outcomes and under wildly bearish outcomes. As we covered last week in detail, if we end up with a scenario that plays out more like a 2008, even with a painful 20% plus drawdown, 1 million to 800,000. In the historical cases, if you mitigated the losses by having a more defensive allocation after the initial drawdown, you could still add a tremendous amount of value going forward. And as we've shown several times in recent weeks, if the present day morphs into something like 1987 or 2011, the painful and devastating feeling in investors' guts that says we'll never recover from a drawdown like this could turn out to be wildly inaccurate based on history. As we covered last week, every single one of these years has some similar characteristic to late 2018, early 2019. And even after a 20% plus type drawdown on 1 million to 800,000, the median gain off the low in these cases was 83%. The average gain was an eye-popping 155%, both quite a bit bigger relative to the painful drawdown we've just experienced. In this case, 800,000 grows to over 2 million hypothetically, and in this case, which is probably more realistic to look at the median, you're still looking at a gain with the 800K clawing its way back to over 1 million. The key from here is to execute properly going forward in a patient, prudent, measured, and data-dependent manner. The model can handle the bearish outcomes and the bullish outcomes. We have to get out of that mentality of emotional swings every day. One day everything's great, the next day everything's horrible. That's the whole reason for using data to try to take emotions out of the equation. We have to remain open to all outcomes in the present day. Outcome number 1, the S&P 500 does not revisit its 200-day moving average for quite some time and falls in this direction. Basic option number 2, similar to this, we go back to a downward sloping 200-day moving average and fail miserably and see devastating losses. Option number 3, which would be more like 1987, 2011, or 2016. The S&P 500 rallies after a bottoming process and eventually recaptures its 200-day, and good things happen for a long period of time. We've ripped it apart, we've dissected it, and unquestionably, we head into 2019 in a better position. Know this with 100% certainty. Gloom and doom sentiment here when the market held at the 200-week moving average. Gloom and doom. Good things will never happen again sentiment here when the market held at the 200-week moving average. Present day, trying to hold at the 200-week moving average. Can't emphasize enough. The present day is still to be determined. What we have in front of us right now looks like a constructive bounce at the 200-week moving average. The longer it stays above, the more meaningful it becomes. If it breaks below, we will learn something from a bearish perspective. Gloom and doom here. What happened next? From the gloom and doom, the S&P 500 rallied 58%. Similar. What happened from the gloom and doom here? It wasn't gloom and doom. The S&P 500 rallied for several years, tacking on over 95%. Trying to make a stand, the 200-week moving average, 2019. All gloom and doom here. The world is ending. What happened after this stand here? Double stand, double retest of the 200-week moving average. In this case, it wasn't all gloom and doom. This drawdown here, looking backwards in the rearview mirror, was a blip on the radar. Didn't feel like a blip on the radar here, but if you stayed focused, good things happened for a long period of time. Discussed last week, present day, very unusual, similar to 1990, very, very rare to get 10% pullbacks in one calendar year. Gloom and doom here. When the market made the stand, the 200-week moving average, it wasn't gloom and doom. In the stock market, sometimes out of gloom and doom, really, really good things can happen for a long period of time. Telling us to keep an open mind about all outcomes over the next few days, the next few weeks, and the next few months. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.